Today I want to talk about Japan through the lens of carry trades, liquidity, and what actually happens when markets stop waiting and start forcing positions to change. If you're new here, I'm Paula. On this channel we step back, away from the noise, and try to understand how everything connects. Crypto, commodities, currencies, and global liquidity, because none of these markets move on their own anymore. Over the last few videos, we've been building a bigger picture. Metals showed us that confidence is being parked rather than deployed. Oil showed us that pressure hasn't disappeared. It's just uneven and distorted. Japan is where those two forces meet liquidity. And the real question right now isn't whether Japan matters. Everyone watching already knows it does. The real question is what's happening with carry trades and whether we're still in a waiting phase or just getting closer to something more uncomfortable. For decades, Japan has been the cheapest source of funding in the world. Borrow yen, sell it, deploy capital elsewhere. That trade quietly underpinned global markets, equities, credit, emerging markets and crypto. As long as Japan stayed ultra dovish and volatility stayed low, that system worked. You didn't need conviction, you just needed stability. But that stability cracked the moment Japan began nudging rates higher. Not broke, cracked. At the most recent Bank of Japan decision, they held rates steady. On the surface, it looked uneventful, but markets didn't read that as we're done tightening. They read it as we're watching very carefully, and that distinction matters. If carry trades were fully back on, the yen would be weakening aggressively, leverage would be building, and risk assets would already be trending higher. That's not what we're seeing. What we're seeing instead is hesitation. Carry trades haven't disappeared, but they haven't restarted with confidence either. Positions are smaller, leverage is lower, capital is cautious. This is the waiting phase. And the waiting phase is uncomfortable because liquidity is thin and markets are vulnerable to being forced. This is where reverse carry trades come into the picture. And this is the risk sitting quietly underneath everything right now. A reverse carry trade is what happens when the logic flips. Instead of borrowing yen and selling it, traders are forced to buy back yen to close positions. That usually happens when volatility rises, funding conditions tighten, or Japan signals it may need to move faster than expected. When that unwind starts, it doesn't stay contained. Assets funded by cheap yen get sold. The yen strengthens further, liquidity drains quickly. And that feedback loop is what markets are watching for. It's where oil plugs directly back into the story. Yes, a lot of Russian oil is being sold at deep discounts, sometimes close to 50%. But that doesn't mean oil is cheap globally. That discounted supply is constrained by sanctions, insurance, logistics, and politics. It isn't freely accessible, and it doesn't set the marginal price. Japan buys oil at global benchmark prices. When those prices stay stubborn, even without surging, a weak yen makes them more expensive in local terms. That feeds imported inflation, squeezes households, and raises political pressure. So oil doesn't need to be high in headline terms to matter. It just needs to stay sticky and uneven. And when you put that together with gold staying bid, you get a very clear signal. Gold tells you capital isn't confident deploying leverage. Oil tells you inflation pressure hasn't fully eased. That's why Japan is boxed in. They want to move slowly. Markets want clarity. Carry traders want stability. So carry trades are paused, not gone. And reverse carry trades aren't dominant, but they're the risk. That's why markets feel sideways. That's why rallies fade. And that's why everything feels tense without breaking. Now this is where crypto really comes into the story. Crypto doesn't just respond to narratives, it responds to liquidity. When liquidity is thin and uncertain, crypto doesn't trend, it chops. It ranges, it frustrates people, but sideways does not mean dead. In fact, sideways markets with volatility are often where opportunity exists, if you understand the environment we're in. When markets are trending, but volatility is still present, you don't need huge directional moves to make money. You need structure, discipline, and risk management. Range trades, rotation, mean reversion, these matter far more than hoping for a breakout that never comes. That's exactly why trading matters in this phase. But this is also why I use blowfin. When the market is moving sideways but still offering enough volatility, execution becomes everything. Liquidity, spreads, speed, and risk controls all matter more than prediction. Blowfin is built for active traders navigating choppy conditions, not just people waiting for the next big trend. And this links directly into the strategies we teach inside the Crypto Liftoff course. The Liftoff course isn't about hype cycles or calling tops and bottoms. It's about understanding market structure, liquidity, risk, and positioning, how to trade trending markets, and how to stay consistent when markets go sideways. Because most people don't lose money in crashes, they lose money in chop. They overtrade, they get emotional, they chase moves that never follow through. The strategies we use are designed specifically for environments like this, where patience, structure, and consistency matter more than excitement. So if you want to know the exact strategies we use to make money in both the bull market and the bear market, we've made the completely free Liftoff course for you. The link is in the description below. Now, looking slightly further ahead, what happens when liquidity eventually comes back into crypto? It never arrives all at once, and it definitely doesn't arrive emotionally. It comes back cautiously. It looks for places where capital can actually work, not places where it can just make noise. The first phase is almost always balance sheet driven. Capital moves into assets that are liquid, widely held, and easy to size. That's why Bitcoin tends to move first. Not because of hype or narratives, but because it's the cleanest expression of liquidity returning to the system. Once confidence improves a little, attention starts to shift. Not into speculation, but into activity. This is where infrastructure comes in. Infrastructure in crypto isn't about stories, it's about rails. When liquidity returns in a healthy way, you tend to see strength first in the parts of the system that actually move value and generate fees. Base layer networks that secure transactions and settle activity, scaling solutions that make those networks cheaper and faster to use, protocols where capital can earn yield without leverage. You've seen this pattern before. Ethereum tends to benefit as activity picks up. Layer 2 ecosystems start seeing volume because fees matter again. Core DeFi infrastructure like decentralized exchanges and lending protocols begin to wake up. Not because of excitement, but because people are actually trading, swapping, borrowing, and deploying capital. These are the parts of the ecosystem that sit underneath everything else. They don't need a new narrative every cycle. They benefit from volume, usage, and confidence quietly coming back into the system. Only later, once liquidity is clearly abundant and risk appetite has fully returned, do you usually see capital rotate into smaller, more speculative narratives. That's typically the final phase, not the starting point. This is why understanding the sequence matters so much. If liquidity is returning because uncertainty has been removed, because Japan has clarified its policy path, because energy pressure has eased, because volatility has compressed, then infrastructure tends to win first. If liquidity is returning because of excitement or leverage, it doesn't last. Right now, we're not in either of those phases yet. Carry trades are paused, reverse carry trades are the risk. Liquidity is conditional. So the opportunity isn't about chasing what's moving today, it's about understanding what benefits when the system actually starts working again. Before I wrap this up, let me know in the comments how you're reading this. Do you think carry trades are quietly creeping back in? Or do you think the bigger risk is a forced unwind? And which type of crypto projects do you think will benefit most when liquidity finally returns? I read the comments and they genuinely shape what we dig into next. If this helps you connect the dots, give it a like, subscribe and turn on the notifications if you want more joined up thinking, because what's happening right now is significant. And understanding context matters more than speed. And remember, being alone in markets like this is hard. That's why we built the Crypto Wolf Pack, so you don't have to navigate it on your own. Thank you so much for watching, and I'll see you in the next one.